My stock videos never do that good, but this is one of the greatest companies of all time, so you guys are just gonna have to deal with it. I briefly talked about Mastercard in my last video, but today I wanted to dedicate an entire video to them and do a deep dive. So we'll talk about their moat, we'll talk about bull and bear cases, and a few more things, including what Morningstar equity analyst Brett Horn has to say about them. And then at the end of the video, we'll run a DCF model and see what our potential returns could be. To start, let's talk about their moat. Why would we even want to invest into this company? Mastercard is a deeply entrenched company with high network effects and switching costs. A bank can't just stop using Mastercards. They would have to have new contracts. They'd have to reissue millions of cards. They'd have to rebuild data connections. It would be a nightmare for banks to just stop using it. And when it comes to their network effects, I'm just going to rip words straight from Brett Horn's equity analysis. But the more consumers that are plugged into a payment network, the more attractive that payment network becomes for merchants, which in turn make the network more convenient for consumers, and so on. This has caused Mastercard to become a globally accepted company, and he believes that in combination with their capital light business model and highly scalable nature of payment processing further cements their competitive positions. This paper was written in February of this year, so it might be ever so slightly outdated, but Brett Horn verbatim says, "We don't believe that building a new network with a comparable size and reach is realistic over any foreseeable timeline, and view Mastercard's position within the current global electronic payment infrastructure as essentially unassailable." He's basically just saying their moat is freaking amazing, but if you want to hear some more jargon, he literally says Mastercard has translated its dominant competitive position into an enviable level of profitability. If only my younger self could see what I was doing now. Moving over to Qualtrim, I know I showed this in the last video, but for the sake of the video, we got to do it again. So looking at their financials, revenue is up 16.7% year over year, and over the past 10 years, it has averaged at least a double-digit growth rate, which is very, very good. If we check out their revenue by segment, their payment network actually is a little bit slower, but their value-added services has been moving up extremely fast. Now, I know this doesn't look like the most extensive revenue by segment chart I've ever showed. I remember when I showed Google, they have like 6 different revenue segments, but don't be fooled. This value added services is very, very deep, and we'll get to that in a second. But just going through some of these other ones, total Mastercard cards, more and more every single quarter. That's what we like to see. People are still continuously using them. EBITDA up and to the right every single quarter, 25% year over year growth, actually phenomenal growth in the EBITDA. Net income is up 20%, and if we just go and double check, EPS should be about the same, 22%. It's even greater. EPS has been seeing phenomenal growth over the past 10 years. That is another great sign. Free cash flow per share. I like to look at this on an annual basis just because it's a little bit easier to see. And really, when I do that, everything looks so clean. But free cash flow per share, stock-based comp adjusted, still 26% year-over-year growth, and phenomenal growth rates over the past 10 years as well. As a dividend investor, this is what we like to see because that means they can continue the rapid dividend growth. They've been growing at 16% on average over the past 10 years, and even over the past 1 and 2 years, you can see we've pretty much kept that up. So the dividend is at least doubling every 5 years. That is amazing, especially as a dividend investor like myself. They do have more cash than debt, or more debt than cash, I'm sorry. But when I was looking at that equity analyst paper, their net debt to EBITDA was just 1.1, and it has pretty consistently been 1.1 for several years. So I really wouldn't worry about that. Again, that was in February, so keep that in mind. But again, wouldn't worry too much about that. I mean, we just saw the freaking crazy EBITDA growth. But if we go back down here, shares outstanding, they buy back so much. Literally, they've averaged like 2% shares bought back every single year over the past 10 years. That is phenomenal. That is amazing. That shoots our EPS up. That doesn't dilute us. That's just a good sign of a high-quality company. Another sign of a high-quality company, high return on capital employed and high return on invested capital. And in Mastercard, we've seen both of these metrics have averaged 40 to 50% over the past 10 years. It has been phenomenal. And you can see that right here. But if we move over to their margins, also amazing margins, 70% gross margins, operating margins, 56% in the most recent year. But that has been slowly going up. And overall, it's just been steady. And profit margin is more or less the same thing. It's at 45%, but slow growth up and overall steady. I wish there was a way I could have made that section a little bit more entertaining. It almost gets tedious to me. It's just amazing double-digit growth in pretty much every section. Financial metrics and ratios are all extremely high. But I have to show you, and these are all phenomenal numbers for a phenomenal company. Next, we can go over some bull and bear theses, and I really like that there are actually some that this Brett Horn guy listed, because ultimately his word matters a lot more than what mine does. I think in investing, it's always good to see the inverse of your side. So let's start with what the bears say. So Brett Horn has a couple bullet points, and the first one is Mastercard is a distant number 2 player in a scalable industry which could hamper long-term margins. I just don't believe this. Now, I know I need more than that, so let's think about this. Their margins have been extremely high and maintained that for several years. Pretty much since the life of this company, they've had extremely high margins, and Visa being bigger than them has never had any effect. Now, I have seen the benefits that a mature company with long-standing good relations can have. Alex actually talked about it in his Lowe's versus Home Depot video. And Lowe's pays significantly less than Home Depot does in terms of transporting all their materials. But a large part of that was because Home Depot tried to back out and use someone else and basically messed up their relationship a little bit. Mastercard hasn't had this problem. And on top of that, this is literally just a capital light business model. Just the way they have built the foundations of their business, their margins could drop significantly, relatively, I guess you could say, but the nature of the business model is high margin, so it can only drop so much. And in addition to that, they have all their value-added services, and I think now is a good time to talk about what that actually is. So any flaws that they might have had as a payment processor is pretty much getting covered by these extra services that they offer. So in 2024, they bought Recorded Future, which is a cybersecurity company. And Joseph Carlson actually made a video about Mastercard like yesterday or the day before, because of course he got his video out before I did. But he highlights that Mastercard is more so trying to be a technology and consulting firm first and a card network second. And with Recorded Future, they have so much access to cybersecurity threats, and they actually now sell threat information and intelligence directly to 45 national governments. And a little side tangent I'd like to go on is Brett Horn states verbatim in this equity analysis PDF. He says, "We see the company's largest environmental, social, and governance risk as data security. Any company involved in processing payments has potential exposure to breaches in its systems." So now Mastercard has taken their largest risk and actually flipped it into a benefit for them. And we've seen what information can do. Look at Palantir. Palantir is literally just an information company, and they have been skyrocketing. I mean, I know that might be a little bit of a simplified definition of them, but largely they're just payments. So not only are they selling this information to governments, but they have even more than that if you didn't think that was enough. People love information and they'll pay a lot of money for it. And Joseph Carlson highlights in his video that Mastercard has the ability to tell retailers what might happen to their revenue if they changed store hours or added a new item to the menu, which I think is nuts. And in a similar vein, they can also tell retailers what might happen if they change their prices or run a promotion. And potentially even better than this, they can tell governments where the most tourism money gets spent to help governments better plan their infrastructure in cities. Mastercard has ridiculous potential, but let's go back to the bear points he brings up. He says the oligopolistic nature of the industry makes Visa and Mastercard a target for regulators, and the companies have historically paid some large fines. I just don't think that's a big deal. I mean, look at Wells Fargo. They have been proven to be committing fraud since like 2002, and they've paid a shit ton in fines, and nothing's really happened to them. And I don't even consider Wells Fargo a high quality company. And even if this was a big deal, obviously Mastercard is still a large company and would be a target, but it's a lot smaller than Visa, at least in the US, and I just feel that Visa would get the brunt of these attacks. But what do I know? But the last point he brings up, he says Union Pay provides an example of how governments could favor local networks, and this could shut Mastercard out of some emerging market opportunities. This one is a big deal. Emerging markets have a lot of potential growth, but you know what? If Mastercard can't capitalize on 100% of it, I still think they have so much to fall back on. It really doesn't even matter that much. But I think we should emphasize key words like could shut Mastercard out of some emerging markets and potential growth. And that's what I've seen with all of these bear theses, I don't know. But all these bear points are stuff that could happen. Whereas all the bull points he brings up are stuff that has happened or just like is. I guess another little bear thesis that I'll throw on. Costco doesn't accept MasterCard. I really don't like that. Costco is an incredibly high quality company. And I actually just watched a freaking video essay documentary thing about how pretty much every Costco that exists benefits the economy around it. So that's not the best for MasterCard. But anyways, let's get to the bull thesis. So none of these are revolutionary, but he says MasterCard has historically outperformed Visa in terms of growth. Its smaller size and some leveling in market share between the two could maintain this trend. 100%. I don't know what else to say aside from that. I mean, it's just true. If you look at both of these companies on a total return basis, MasterCard has been destroying Visa, and they're still focused on growth, which I'll talk about in a second. But he also says there's still plenty of runway for growth in electronic payments. Electronic payments only surpassed cash payments on a global basis a few years ago. Now, that sounds great, and it is, but according to several sources on Google, only 8% of the world is currently using cash. So the benefit might not be as big as it seems. But I think they still have several years before this is even a problem. And at the very least, this gives them a runway to build up these value-added services I've been hyping up so much. But his last point, he says, is management is appropriately focused on long-term growth opportunities and not near-term margins. I love this. I think every company that focuses on growth as opposed to just making money does better in the long run. We've seen this with Meta. For some reason, investors don't like when companies do this. I don't know why, but Meta stock dropped a lot because, they were so focused on AI, whatever. But now they are in such a good spot, and their stock has been doing pretty well aside from this recent sell-off. We're currently seeing Duolingo do this, so we'll see what happens in a few years. But I am a big believer of this line of thinking. And to inverse this, look at Apple. I think Apple is garbage. And what do you know it? They haven't done any type of innovation, and their revenue's been stagnating for years. I do want to talk about credit cards more in the future, but another little bull case I want to throw in there is that they're partnered with Bilt, which to my knowledge is the only card in the entire world that you can pay your rent on. So you can get points literally just for surviving. On top of this, they're partnered with Alaskan Airlines and Hyatt, which I've heard are both pretty good. And in 2026, they're supposed to be coming out with a card that you can pay your mortgage on. So even more runway for growth. But now let's take a moment to talk about stablecoins. A little tidbit from my life. Brock Pierce, the co-founder of Tether, actually came into my job the other day. And that's about half of what I know on stablecoins. The biggest threat that I've heard is that stablecoins could just bypass MasterCard entirely. But MasterCard and Visa both welcome stablecoins, and they're actively trying to integrate them with what they've already built. And MasterCard is already partnered with several, including USDC, which is a huge one. But again, if they integrate this on top of what they've already built, they will make moving money faster and cheaper. It'll reduce fraud. You won't have to wait days. You can wait seconds. And overall, I just think this is just a bullish sign. I know people are scared of stablecoins, but I think it'll improve Visa and MasterCard and make them even more efficient than they already are. Something else I wanted to bring up is Tom Lee went on a podcast not too long ago and said in our traditional financial architecture, he called it, there's a lot of friction and intermediaries and things like that. And he believes that this will kind of get cleaned up and make the financial sector grow a lot and essentially move and have PEs similar to the tech sector. I think Mastercard has a lot of growth paths, and Tom Lee seems to at least vaguely agree with me, which makes me feel pretty good. So let's plug it into a DCF calculator and see what our potential returns could be. So on a trailing 12 months basis, Mastercard's earnings per share growth rate has never been below 16%. So I think we can assume 15%. That's slightly conservative, and their PE has averaged about 36 and 37 over the past 5 years. So again, being slightly conservative, I think we can say 35, and that comes out to about 15.3% average per year over the next 5 years from today's price. And those of you familiar with the rule of 72, that means we would double pretty much from today's price over the next 5 years, with Q1 of 2030 projecting $1.1 thousand price target. And a lot of people think it might grow even faster than this. Joseph Carlson actually ran a couple more, and he got two averages, one being about 20% growth per year over the next 5 years, and another being about 24%. So I know it varies a lot, but I actually think 15% average per year over the next 5 years is base case. So we'll see what happens, but I think Mastercard is a phenomenal company that has been and will continue to outperform the market. And I think now is a greater time than ever to buy. My terrible Mattel position has been going up a little bit, and now I'm only down single digits. So I'm really thinking of selling at a slight loss and throwing it all into Mastercard. We'll see. I'm going to try not to wait too long and end up losing all my money. But that's about it. In other words, my dividend income just hit about $500, which was really cool because according to my job now, I basically just bought back a week's worth of my time, which I'm very excited about. But anyways, that's pretty much all I got to say about this video. My dog is playing with a toy in the background. But I hope you got something out of it. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.